of you at this point are well aware of what is going on in the oil sector, and it is causing mass disruption through the financials. Banks are just getting slaughtered, which makes them start looking pretty attractive. In fact, I even went ahead and bought my mom some banks this morning, which I'm going to reveal to you what ones I purchased toward the end of this video. Looking at my personal exposure to start it all off, right now I have about 15% total exposure of my portfolio in the banks, and I'm actually planning on expanding upon that because I love the dividends. It makes up about 10% of my dividend pie, and I wouldn't mind that being a bit of a bigger chunk. Taking a look at some of the hardest hit banks that have the most exposure to the oil sector, we're talking on the Canadian side of the border first. Bank of Montreal being down roughly 30% in the last year alone, with a 5.7% dividend and a crazy PE of only 8. In fact, if you go on Bank of Montreal's website, they have a specific page dedicated to the leverage and loaning of the oil and gas sector. Now, moving into the U.S. side, however, we got Bank of America right now with a loan exposure of 10%, but recently on their last 10K filing, they said exposure to the energy industry was $36 billion, or 3.5% of the total commercial credit exposure. So if it's only 3.5% of their exposure, is it really worth the stock being down, like if I can get this to line up here, roughly 37.6% with a 3% yield and a PE of 8? I mean, there is a lot of other things that have the capability of disrupting the bank sector right now in different economies. For instance, our Canadian economy, we've had pretty much negative GDP since 2014. We haven't been able to go back into the green here, and there are a lot of other things coming into this economy that might cause issues. I'm sure you remember the good old Steve Eisman from the Big Short movie that was shorting the Canadian banks. He might be making some money on them now, but we could see like some triggered losses happening, and if it gets worse or we have issues with real estate, we could see some real problem in the financials. So what I'm going to do today is we're going to break down some fundamentals on my favorite banks, and then I'm going to reveal to you the banks that I bought my mom. So ladies and gentlemen, let's jump right into this.
Drop it.
Welcome back, my passive income investors. I like it. And before we get into all of this, if you guys love this transparency and the work that I'm doing, consider slapping that like button for that YouTube algorithm. I'm getting right into this, starting with the Bank of Montreal. I'm going to be using the fundamentals that come up on my Scotia iTrade account because it does give me some pretty healthy statistics here. Really high dividend of 5.8% on BMO. And this stock, man, these bank stocks were like world renowned for years, and now all of a sudden they're like the worst things you could possibly own, apparently. But I'm just going to deep dive really quickly into some of the key statistics, and then we're going to get into the balance sheet just briefly because we have a lot that I want to go over. But taking a look at their earnings as of recent, we've got about $8.77 a share. Cash flow is really half decent here, considering BMO is outperforming the general industry. But where things really come into reliance is the dividend even sustainable, considering Canadian Imperial Bank actually increased their dividend, which we'll get into. But taking a look at price to earnings is 9.6, not as high as I'd like to see it, but still half decent. And the payout ratio that really matters here, I also like looking at the return on assets and equity. It's nice when these are a lot higher, but the banks, because they're used to using leverage, their margins are usually a little bit smaller than that. But taking a look at the dividend payout ratio, it is only 0.5 times. What that essentially means, if you are new to investing, is that if they lose 50% of their earnings, they could still afford to pay the dividend that they're currently paying, that is at 5%. And this is why most of the Canadian banks have become world renowned. Taking a look at the balance sheet, we won't really see how hard they're getting hit until the first quarter earnings. But taking a look at the growth from, say, 2016, it hasn't been massive, but we've still increased the bottom line by about $700 million over 2016. No crazy huge growth, but in this sector, we're not looking for major growth. We're just looking for reliable dividends. So moving into the next stock here. So BMO, even with the exposure it has to oil, I think it's being way too oversold here. So let's look at one of my favorite banks, Bank of Nova Scotia here, paying a 6.1% yield, a lot higher than most of the banks, $72 billion market cap. And let's just get right into the fundamentals here. Taking a look at the base statistics here, guys, we got a price to earnings of 9.8. Earnings are $6.86. I'm taking a look at the return on assets and equity here, a little bit higher than BMO overall, but again, a payout ratio of 0.5 with a 5.4% dividend yield. And the fact is Bank of Nova Scotia does doesn't have nearly as much exposure to the oil sector. And I think this is one of the best performing banks on the balance sheet. Actually, you know what? The performance isn't that much different. Taking a look at 2016, this is property plants. Maybe we'll take a look at total assets because this will be a little bit more reliable here. I hope I wasn't doing that on BMO. I might have been taking a look. Property, plant, and equipment gross, but even still, gross income helps out here. And we can see it has the same income increase, about 600 million from 2016, similar to BMO. Again, not huge growth here, but the return on, or the total asset increase has been massive. As we can clearly see, the assets have increased drastically on this company. And we should probably also point out the total liabilities here. I didn't do that on BMO. Maybe we'll go back and take a quick peek because I don't want to skip over too much, but let's take a look at the assets versus liabilities. Presuming that our total liabilities are 801 and our total assets are 852, that means that this bank's only got about 52 billion in underlying assets. And if we take a look at BMO for the underlying assets, the company's worth 47 billion. So they're trading excessively close to their underlying assets. And I think this is going to be a common theme amongst many of these stocks, considering Bank of Nova Scotia is also sitting on about 50 billion in assets, underlying assets, mind you. They're sitting on about $1 trillion in assets, which is also the liabilities. That's a pretty incredible balance sheet overall. But let's just take a look at BNS here. If we're sitting on 50 billion in assets and the total market cap is 71 billion, you're not getting the best deal compared to BMO, but overall, man, that is like unbelievable. I always love buying companies as close to their underlying asset value as humanly possible. I think it is one of the best ways of gauging the value of a company, because if a company has more liabilities than assets, it just simply means that they had to liquidate the company and not make any money tomorrow. It just means that they would owe more than they actually have in value, which gets a little sketchy. It's a really good analytical tool that you guys know I over promote all the time. Now, taking a look at our last Canadian bank, we're talking about Canadian Imperial Bank, another one that I personally own with a 6.8% dividend yield. It is one that has been getting hit the hardest over the last few years, primarily due to their exposure to the mortgage sector and Canadian real estate. There's been a lot of concern around Canadian real estate, and it has caused the stock to have some pretty wicked mood swings here. But taking a look, we got a $38 billion market cap, a 6.8% dividend yield, and a PE of 7.7. I never thought in this day and age I would be saying a PE ratio of 7. Let's get into the fundamentals real quick with this guy. Taking a look overall, guys, earnings of $11.25 a share, not bad at all. Let's take a look at the return on equity and assets, a lot higher than most of the other banks, primarily due to the fact that they're mortgage exposed. Mortgages pay really good yields. Maybe not as great moving forward because the interest rate is dropping, but taking a look at the dividend yield, and again, 0.5 times. They're all paying out 0.5 times their income. But let's take a moment to compare this to the assets versus liabilities yet again. Taking a look at the property, plant, and equipment gross, same sort of increase, not nearly as much, unfortunately, as those other banks. We're only seeing a $300 million increase since 2016. But with total assets versus liabilities, this company, not nearly as good as the other banks. We're looking at something like $38-ish billion in underlying assets. So we're looking at about $38 billion in underlying assets. And what did I say? $38 billion, guys, a market cap. You could buy Canadian Imperial Bank for exactly what it is worth on its underlying assets. Absolutely. Round of applause, ladies and gentlemen. I think we are fair to say we are in discount territory. I love it. Getting a little worked up here, guys. I've just, as a dividend investor for the last 5 years, this has never happened. Very unusual. Let's get into the U.S. side. Looking at Wells Fargo, one that I personally own as well, with a 6.2% dividend, $135 billion in underlying assets, and a PE of only 8. Getting into that balance sheet and fundamentals, where are we here? Let's keep scrolling through. Wells Fargo has been taking one of the worst kickings, down 50% roughly, or maybe 40% from its all-time highs. They've had a lot of scandals. Now they have the oil problem. And what is that doing for their balance sheet? Well, let's take a look. They got earnings per share of $4.35 on assets and equity, a little bit lower, but that's probably because of the exposure they have. This company's managing over $8 trillion in assets, which we're going to see, again, paying out 0.5 times their earnings. Oh my God, guys, when we're talking about dividend yields here, you're not going to be complaining. Could you imagine getting a 6% yield with a 50% margin rate? That just, again, they could lose 50% of their revenues and still afford to pay that dividend. Very unusual stuff. They've actually lost on some of their cash and short-term investments, but that's nothing major. But let's just take a look and see how much they're managing. On total current assets, well, we want total assets of almost $2 trillion. Sorry, I misspoke. They're managing almost $2 trillion. $2 trillion. I got to put my finger up here when I'm saying these numbers. That is awesome. Like, that is the definition of the word awesome. Unbelievable. Taking a look at their total liabilities, or total liabilities of $1.7 trillion. That gives them about a $300 billion valuation. And is that company worth $300 billion? No, it's trading at $135 billion market cap. Does that make sense to you? Because to me, that rings discounts. But I want to show you one more thing, because the problem with Wells Fargo is they have been under some heavy drama lately, and we can take a look at their cash flows, and this is where we see the reason the stock has dropped so much, going from 2016 with about, 22 billion all the way down to 20 billion. So they have been bleeding capital based on their news. But does that justify the drop in the stock? In my personal opinion, absolutely not. But moving into Goldman Sachs here, the Goldman Sachs, I'm going to try and remember this number this time, $61 billion in assets with a 2.8% dividend and similar PE ratio. But is it, that would basically mean that Wells Fargo is on a bigger discount right now than most of the entire Canadian banks. Fascinating stuff. So let's look at the key statistics here with earnings of $21. Payout ratio is 0.2 times. Return on equity assets here, nothing crazy. Profit margins are really nice on these banks. The U.S. banks have some really healthy profit margins. Taking a look, before we get into cash flow, let's just take a look at the balance sheet. Cash and short-term investments have actually increased amazingly since 2016. So probably a little bit better performer, but with total assets minus the total liabilities here. So we have a total asset value of just under $1 trillion with a total liability of about 900 billion, giving us just under 100 billion in valuation. Cash flows have increased beautifully. So this company is on the up and up overall. And again, taking a look at the market cap trading well below it, guys. So again, you're getting these bank stocks for less than their underlying asset value. Unbelievable. So anyways, taking a look at our final stock here, Bank of America, one of the more heavily leveraged oil banks, but let's be real, in perspective, it's not that much. But taking a look, we got almost a $200 billion valuation, 3.3% dividend yield, and 7 PE, a little below 8 there. Should say 8, but it's fun seeing that 7 number. Getting into the fundamentals real quick here, looking at these key statistics again. Profit margins are at almost 30%. So far the highest that we've seen here, with the dividend payout of 0.3 times. Man, it makes me chill. It's crazy. I'm not over exaggerating here. I know I'm kind of getting caught up in all this, but when I'm looking at this, it just doesn't make sense to me at all. But let's just get into the balance sheet. Again, taking a look at the total assets versus liabilities, $2.4 trillion with a total current liability, or total liabilities of $2.1 trillion. So that's going to be leaving us with about a $300 billion valuation yet again. Taking a look at the cash flows real quick, it looks like everything has been increasing substantially. So far, one of the best performing banks we've seen overall, and clearly only worth $192 billion. Again, another crazy discount. You could be getting a 3.3% yield that has a 70% protection rate against their current cash flows. And I don't even know where to begin with this, guys. If you do not find these attractive at these levels, I mean, we could run into any kind of issues. But the problem is all the issues that we're speculating on causing this disruption in these bank sectors, it isn't reality. It's purely spec-based, and nobody's running the math here on how much they could be hit by the oil sector. But between the virus and the oil sector, it's caused this perfect storm of speculation, driving the bank stocks into the toilet. As a dividend investor looking for quality, this is why I went out of my way to purchase my mom some bank stocks this morning. And we went ahead and we bought Wells Fargo, and we bought some Bank of Nova Scotia. I mean, we're not talking about crazy huge investments, but as I primarily like chasing high yields, especially high yields that have a decent safety rating, you're not going to go wrong with these stocks, guys. They have underlying assets that well outweigh their... So I don't even know how to explain this, guys. And I hope I'm not misquoting this. If I'm saying anything wrong, feel free to correct me. I'm learning just as much as you guys are. But being in the markets for 5 years, literally dealing with this almost on a daily basis, I've come to recognize this a little bit more clearly. And it makes me very comfortable in my stock portfolio, which I'm kind of getting a little bit more cockier about. I find my cockiness after watching the video I posted yesterday, which you guys should check out because I'm down $20,000 on my portfolio. I get a lot more cockier when things get bad, because when things get bad is when I feel more reliant, let's say. It's when people start jabbing me and they start telling me how I should be investing and how I'm making mistakes. And it forces me to do stuff like this and go back and analyze all of these companies, only to realize that these are great companies. There's nothing wrong with them. And then I get cocky because people start telling me I'm wrong. And could I be wrong? Yes, absolutely, but I doubt it. Anyways, guys, gonna leave my cockiness there. Let me know what you think about all this in that comment section below. Stay cool, stay awesome, and I look forward to chatting to you tomorrow.